Club's theater series, Public Light in the Spotlight, continues with Echo Theater's performance of The Yellow Boat on January 20th. That's a Saturday. The Yellow Boat is a play about a young boy struggling with AIDS. He embraces the experience as an opportunity for learning about fear and ignorance. This play is about the value of living life to the fullest. It's for people of all ages. Discounted tickets are only $10. Citizens Read selection for January is Greg Mortensen and David Oliver Renlund's 3 Cups of Tea, One Man's Mission to Fight Terrorism and Build Nations, One School at a Time. They'll be meeting on Monday, January 29th. This is available to members and guests alike. And finally, you are invited to a party on Friday, January 26th, we have a final Friday, the City Club's open house. And City Club members and their guests are invited to drop by City Club Commons between 4:30 and 6 to share refreshments and conversations. I hope you'll come. We have a few new members today, and I'd like to introduce them, ask them to stand, and be welcomed by the other members of the club. Our new members today are Robin Harkless. Could you stand, Robin? And John Calvin. We'd like to welcome you and invite any of you who are guests today who are not members of City Club to join. We'd love to have you. We are so fortunate in Portland to have great corporate citizens to sponsor these programs and help make them possible. Our sponsors this quarter are Girding Edlin Development Company, LLC, and McEwen Gisvold, LLP. Would you please join me in thanking them? On the first week of every new year, City Club of Portland presents a Friday forum on the economic forecast for the upcoming year. We're fortunate to have with us today 3 economists who are not only knowledgeable, but understandable and entertaining. Our plan here is to move from the national scene to the regional and then to the local. We will begin with John Mitchell, followed by Joe Cortright, and then Jerry Johnson, and then followed by an ample period of time for questions from the audience. After about a 4 or 5 year hiatus, we are so fortunate to have John Mitchell back with City Club. John has presented the economic forecast to City Club some 15 or 20 times over the years. John was Chief Economist of U.S. Bancorp from July 1983 to July of 1998. He is currently U.S. Bancorp's Economist Western Region and the principal of M&H Economic Consultants. John writes U.S. Bank's Economic Update, a bi-monthly in-house review for the bank that covers Oregon, Washington, California, Idaho, Nevada, Utah, and Arizona. When John isn't focused on economics, he exercises another part of his brain, working on narrow-gauge railroads. For the last 9 years, he has volunteered for the maintenance crew on the Cumbres Toltec Railroad in Mexico. Joe Cortright is an economist with Impresa, a Portland consulting firm. Joe is 2 people down here. This is a firm specializing in regional economic analysis, innovation, and industry clusters. He is also a non-resident senior fellow at the Brookings Institution and the Chief Economic Analyst for the Oregon Business Plan, a multi-year private sector-led effort to develop the state's economy. And you may have read about this in this morning's Oregonian. He was a presenter at the Oregon Leadership Summit yesterday. Joe has also written extensively on the migration of talented young workers among metropolitan areas in a series of studies entitled The Young and the Restless. His work is quoted regularly in the media in publications ranging from the Wall Street Journal, the New York Times, the Economist, Business Week, and USA Today. The secret to Joe's success is that during his formative years, he served as an intern at the City Club of Portland. Joe worked on the Mass Transit Committee, and this was even before the time of Ray Polani. Jerry Johnson is a principal in Johnson Gardner, LLC, and is currently among the leading consultants to private sector developers in the region. His firm is viewed as the primary source of real estate market evaluation by the many of the area's largest commercial bankers. Jerry consults on a broad range of real estate development and land use economic topics for both private and public sector clients. When Jerry leaves the heady world of economics, he coaches soccer for 10-year-old girls and a boys' t-ball team. We will begin with John Mitchell.
Thank you, Susan. It's very nice to be here today. These are fascinating times to be an economist, an observer of the national environment. I was worried that when I got up this morning, when those employment numbers were going to come out, I was going to have to change what I planned to say, but I didn't. Okay. You look around at the moment, this upturn has entered its 6th year, sometime in November. We've got relatively tight labor markets. Unemployment rate stayed at 4.5%. Gain in payroll employment last month, 167,000, upward revisions to the previous 2 months. 15 years ago, when you were talking about employment, you'd have to say except for California. Well, now you say except for Michigan. Okay. 49 states have annual employment growth except for Michigan. We have the unwinding of a housing boom, which I'll touch on. I'm sure Jerry will talk a lot more about. A pretty strong global economy. Net worth is continuing to increase. You look at the Federal Reserve data, consumer balance sheets continue to show gains in net worth. Core inflation is above the Fed's target, although albeit the headline number on a year-over-year basis is at 2%. We've had a monetary authority really on pause since the middle of last year. Okay. We have an inverted yield curve, and I'll talk more about that. I mean, basically what that says is short-term interest rates are above long-term interest rates. You know, that's the sort of the broad national environment. Now, we don't have data yet for 2006 and how the U.S. economy did. In 2005, output was up about 3.4%. It's going to come in very close to that, probably a touch below in 2006. Okay. But the pace of the upturn clearly slowed as we moved through 2006. Growth rate in the first quarter was 5.6%. The third quarter came in at 2%. You know, when we look at that most recent quarter, and you saw an acceleration in consumer spending, okay, but you saw a big drag from housing. Housing subtracted about 1.2% from the growth rate. So had housing been flat, we essentially would have been at 3.2% rather than 2%. Now, I'm 62 years old, okay? An advantage of that, at least for a while, is you get to remember more stuff, okay? I can remember the long expansions, the 1960s, okay, the 1980s, the 1990s. If you look at those long upturns, sort of interesting that they were all interrupted by periods when economic growth slowed, there was lots of concern, but those slowdowns did not morph into recessions. And I think that is the most likely scenario for 2007. What I suspect is going to happen is that the U.S. economy is going to continue to grow. GDP growth rate, gross domestic product, the output of the U.S. economy, I suspect will increase something around 2.5%. But it's going to look different than the last couple of years. You won't see the same kind of strength in housing. I mean, residential building permits through November were down 14% compared to the previous year. If you just look at November, issuance of building permits was 31% below what it was the previous year. So we've got that drag from housing that I don't think is over. I think we'll continue to have support from business investment, both non-residential construction as well as spending on equipment and software. Capacity utilization rates are relatively high. Cash flows are strong, balance sheets are pristine, credit's available. That strength in the global economy that I talked about should continue to result in strong export growth. And consumer spending, while lacking support support from rising real estate values the way it has had in the past should hopefully continue to be supported by rising income and employment. From an inflation perspective, in the last 12 months, the consumer price index rose 2%. And if we exclude food and energy, the core index was up 2.6%. We've had a lot of volatility from the energy side as those shocks have worked through the system. But what I suspect is going to happen is that the somewhat slower growth, as well as better behavior on the energy price side, continued gains in productivity, will help bring that rate of inflation back down toward the 2 to 2.5% range. You know, it's interesting that if you think back over the last 24 years, we're almost going on 25, to late 1982 up until the present time. Over that episode, or interlude, we have had basically 16 months of recession, an incredible period of stability that economists have come to call the great moderation. And I think one of the reasons for that is the adherence of central banks in many parts of the world to the objective of holding down the rate of inflation, sort of providing that sort of more stable background in which for the economy to function. So the Fed is still focused on that. Okay. From a rate perspective, okay, we saw, starting back in mid-2004, a series of 17 consecutive rate increases by the Monetary Authority, 25 basis points, a quarter of a percentage point at each meeting as they took the federal funds rate from 1% up to 5.25%, withdrawing that accommodation that had been administered to the economy earlier in this century. Then they paused in the middle of last year. Right now, we have an inverted yield curve. Okay, short-term rates are above long-term rates. For example, the overnight federal funds rate target is 5.25%. Okay, the 10-year Treasury is trading close to 4.7%. Short-term rates above long-term interest rates. Now, as a former academic, you always have this desperate hope that somebody remembers something from their economics or finance class. But I suspect some of you are saying, hey, an inverted yield curve, oftentimes that's been a harbinger of recession. There was an article last fall in Barron's that made the point that inverted yield curves have successfully predicted 8 of the last 6 recessions. It is not perfect, okay? It is not perfect, but it is something that one has to pay attention to. Now, the question becomes, okay, does it have the same meaning now, or is it something different? It's sort of interesting. A number of Fed governors have spoken to this subject over the course of the last year. Chairman Bernanke talks about a glut of savings in the world, helping to drive down long-term interest rates. This is not just a U.S. phenomenon. It may be that relatively low volatility. I talked about that long period since 1982. Less concern about inflation. Desire to hold U.S. assets. All those things offer some additional explanations or can partially explain that inverted yield curve. But time will tell. The Fed's next move, I believe, will be down, but I don't think it's going to be quickly. Okay. And I feel more strongly about that than when I got up this morning, okay. By virtue of the strength in the employment numbers that we saw today and the upward revisions over the last few months. I suspect by mid-year you will see the Federal Reserve start to lower short-term interest rates. Long rates have already moved down. Not a bad environment for year 6. The risk has increased, no question about that. But I think continued up, slower GDP growth rate, inflation moving down, and some slow declines in short-term interest rates as we move through the year. There are certainly significant risks out there. You know, the one that I lose the most sleep over is housing. And the way the housing weakness might spill over into the general economy. Not just sort of the construction aspect, I mean, that was the drag of 1.2 percentage points last quarter, but rather the impact on consumer spending to the extent it impacts consumer balance sheets and mortgage equity withdrawal, which people had been using extensively. The offset would come presumably if we continue to have rising incomes, rising employment. But that certainly is a concern. I'm also assuming that business investment holds up, as does trade-related activity, the global economy. There's always the risk of an energy shock. Okay. Prices are down off their highs, but the margins of excess capacity are still relatively limited, and you could conceive of terrorist events or natural events. I mean, we dodged a bullet from a hurricane standpoint. We didn't have major hurricanes, no major disruptions there, but that risk is there, or some terrorist threat, those sorts of things. I would also point out, that 360 days from today, the first baby boomer will start to get Social Security. I mean, that long-term entitlements issue is still out there. Well, it's not a bad national outlook. Clearly the risks are there, but I think it's rather going to be an interruption, a period of slower growth in a longer-term expansion. Now, what I like to do at the start of the year is I take my outlook and sort of summarize it in terms of a poem, and I will inflict that upon you. The duration in August hit the post-war mean, 57 months up and the light was still green. Change was in the air as the cooler fall drew near, homes were sitting longer and some prices were less dear. Unemployment was low and wage pressures grew, capacity was tight in many industries too. Productivity gains diminished or were revised away. The complacency about labor costs began to fray. Energy once again had cast its long spell as near $80 crude emerged from the wells. War, corrosion, demand, and an abundance of fear kept oil prices for a while very dear. Few storms and inventories that continued to grow had OPEC attempting to turn down the flow. Ethanol, windmills, some temperature change, maybe the harbingers of new approaches coming into range. St. Al has moved on to a different place. Ben Bernanke now reigns in that awesome space. Preventing inflation is the Fed's divine mission. 17 moves have given way to a lasting intermission. The steroidal 5.6 of 06's opening act fell to 2 in Q3 as housing sank back. Moderation and policy already done are the hope for policymakers to continue this run. The yield curve is flat to rather inverted, a shape not to be ignored as history has asserted. Job growth has eased to just about 7 score. Housing is cooling and we will see more. 07 will bring year 6 of this run, but things could go wrong that could make it less fun. Adjustables adjust and energy can be disrupted. With more price pressures, rate increases were only interrupted. The first boomers are 61 and considering their fate. Their first checks will be in the mail about a year from this date. Pelosi and Reid replaced Hastert and Frist. In November 06, the R's got really dissed. The divide may result in groping toward some solutions for entitlements and other issues that have defied resolution. Iraq greenhouse gases and more moves on health care raise the minimum wage and save the polar bear. Doha's demise is a cause for concern. Lessons from the past we will hopefully not unlearn. The first upturn of the millennium is wavering but still in gear. It most likely will continue through next year. The pace will be slower, the mix will alter, stretched consumers, more exports, and housing that will falter. Falling gas, more jobs, and balance sheets near perfection will keep us away from a change in direction. Thank you very much for your attention.
It's very difficult to follow the world's only poet economist. And John is a violation of the fundamental definition of what an economist is. You all know an economist is somebody who's good with numbers, but doesn't have the personality to be an accountant. But actually, we can't say that anymore because accounting has changed so much in the last few years. Now an economist is somebody who's good with numbers but isn't creative enough to be an accountant. Some of my best friends are accountants, and today I've kind of structured my remarks to be sort of the accountant's view of the regional economy. John's giving you the national outlook. I'll be bringing it a little bit closer to home, focusing on the state and then primarily on the metropolitan area. And I'll be talking basically about our income statement, the flow of money in and out of this region, the balance sheet, how we stand, what our assets and liabilities are, and then give you a couple of forward-looking statements. But before I do that, I want to give you what is undoubtedly, if not the best information about the regional economy, certainly the most recent information about the regional economy, because I always compile what I call the City Club Economic Index, and you all contribute to or actually cause the City Club Economic Index. And it's based on a long-term observation that when the economy is in trouble or is headed downward, more people come to this meeting in January to listen to economists. And when things are good, the attendance here is pretty thin or declining. So we can usually, if more people come, that's a bad sign. If fewer people come, it's not a good sign. Last year, you correctly predicted a continued strong economy. There was about a 25% decline in attendance over the previous year, which tended to be a positive sign. Today, it's just as John characterized for you, a favorable outlook, but a little bit of risk on the downside. There's about a 3% increase in the attendance over last year. So that's may turn out to be the most accurate indicator of the local economy. But let's march on now and talk about the income statement, or basically the measures of economic activity in the Portland metropolitan area. We have clearly recovered from the recession that we experienced earlier this decade. Portland's metropolitan employment is now at an all-time high of more than 1 million wage and salary workers. After 3 years of declines in job growth in 2001, 2002, and 2003, we've had 3 years of year-on-year improvements in job growth. 3.2% last year, a little bit slower, 2.6% is the best estimate for this year. We experienced about 30 months of year-on-year declines in employment from July 2001 to January 2004. So we experienced that recession a lot more severely and over a longer period of time than did the nation as a whole. But since January 2004, we've seen the Portland economy outperform the nation every single month for the last really 35 months. So very strong economic performance locally. That's had the effect of moving our unemployment rate steadily downward. We peaked at nearly 9% in 2003. Currently, we're below 5%, and we're basically within spitting distance of the national average with an unemployment rate in the metropolitan area now of 4.7%. Now, what are the reasons behind our economic performance? Well, if you've heard me talk before, you've probably heard me talk about industry clusters. The structure of our economy is not random, and it's not the same as the nation. We are strong in a number of particular industries that are big drivers for our regional economy. In particular, we tend to be strong in durable goods manufacturing in a series of clusters as diverse as high technology, metals, transportation equipment, and wood products. And part of the reason we experienced the recession more severely than the rest of the nation was because we were overrepresented in sectors or in clusters that experienced the national recession more severely. But the news of this recovery is that in every single major sector of our local economy, our industries are outperforming the same industry nationally. So for example, in high tech, which is the largest industry regionally, the high tech industry's employment nationally has continued to decline even in this economic recovery. It's up more than 9% locally over the last 3 years. And that same same story can be told about wood products, the metals industry, transportation equipment, sporting goods, and apparel. Our industries are outperforming the same industry nationally, which is a very favorable sign. So that's the income statement, some pretty favorable news there. But if you run your own business, you know, you can't simply pay attention to this year's or this quarter's income statement. You need to look at the fundamentals. You need to think about shareholder equity and whether you're adding value. And you want to look at what's happening with the balance sheet. Now, you might think of the balance sheet as being the physical assets of the place, the $3 or $4 billion worth of roads and streets and bridges that we have here, the $40 or $50 billion of property that we own. But the biggest asset in this region is the value of the knowledge and the skills of the people who live here. A rough estimate of the value of the human capital of this region, of the Portland area, would be in excess of $250 billion, dwarfing the value of the physical assets here. And the big driver of our economy in the 1990s and more recently has been the rising level of educational attainment of our population. During the 1990s, the number of college-educated 25 to 34-year-olds, the group we call the young and the restless, increased 50% in the Portland metropolitan area, more than 5 times faster than in the country as a whole. And the bulk of that increase was concentrated in the close-in neighborhoods of Portland. Basically, the number of young adults grew 3 times faster within 3 miles of where we're sitting right now than it did in the rest of the city. And what we seem to be seeing is what I would call the Skidmore fountain effect. And you as good City Club members know the inscription on the Skidmore fountain. Good citizens are the riches of a city. And it turns out that well-educated citizens are in fact the riches of a regional economy. And one of the really significant trends we see here is a continued improvement in the educational attainment of the local population. One of the striking things is how much Multnomah County's educational attainment has gone up relative to the rest of the region. And to give you an idea of how much that's changed in just the last decade and a half, it used to be the case that the college attainment rate, the percentage of the population with a 4-year degree, was about 6 percentage points higher in Washington County. And that was true in 1990. It was about 4 percentage points higher in 2000. Today, Multnomah County's college attainment rate has risen to where it's statistically no different than the educational attainment rate in Washington County. So we are very well educated, particularly in the center of the region. At the same time, the region's educational attainment has continued to improve. Well, why is that important? Why is that a driver for our economy? And what might it bode for the future? And this is where I launch into the forward-looking statements portion of our accounting analysis. The important thing to keep in mind is we are in the midst of a transition from an economy of physical things, an economy of stuff, to an economy of ideas. And unfortunately, most of the metaphors that we have for describing the way economies worked are still rooted in the 19th century economy of making and moving physical things. But the big determinant of economic growth, particularly for metropolitan areas, is their ability to create new ideas and to use those ideas to form new businesses, to create new products, and to solve social problems. I work with a national organization called CEOs for Cities, and we've developed a new framework for thinking about what it takes to have a successful urban economy. We think there are 4 critical ingredients: talent, innovation, connections, and distinctiveness. And we've ranked all the 50 large metropolitan areas on each of those 4 criteria and found that Portland is really one of the probably 10 best metropolitan areas in each of those areas, has done very well in talent, ranks 7th in the nation in terms of innovations, patents per capita, is very well connected, and we look at both the economic and social fabric, and it also does well on measures of distinctiveness, including something we call the weirdness index. So that bumper sticker you see around town about keep Portland weird isn't just a social statement, it's also economically important as well. And let me just for a moment talk about one element of distinctiveness that I think has particular importance to our region. And it came up as a major theme in yesterday's Leadership Summit, part of the Oregon Business Plan. And that's the theme of sustainability. One of the things that has emerged really as a strength of this region, and that is a very globally recognized strength, is our close connection to the environment and our commitment to sustainability. And last year at the Business Summit, literally 12 months ago, we heard from Michael Porter of the Harvard Business School, one of the world's leading business strategists. And what he told the assembled business leaders then was this: you've got to create a unique regional value proposition. That's a good business school term. What is it that makes Oregon different than any other state? The really successful states have carved out distinctive positions that create a magnet for industries to locate there. Not for every industry, but for the industries for which they are trying to build a position. Well, yesterday at the Business Summit, you heard a panel, if you went, you heard a panel of business leaders talking about how critical sustainability was, not just to this region, not to us as people, but to them as a business strategy. Alan Alley, who's the head of Pixelworks, said, economic development in harmony with our planet is not only the right civic thing to do, it's the right business decision. And I think you would be very hard-pressed to find a group of business leaders anywhere in the country who have that kind of attitude about how sustainability figures as an opportunity to grow their businesses and their bottom lines. And I think as we look forward, as the critical forward-looking statement, as we think about a strategy for our region to try and influence the economy, it's important that we think about devising a strategy that will make Portland the very best Portland that it can be, and not to follow strategies that would make us a poor imitation of a strategy that we think somebody else pursued decades ago to be successful. So with that, I'll conclude my accountant's report and turn it over now to Jerry Johnson. Thanks.
Thanks. Now for the non-professional speaking portion of your program. We've talked a lot about economics, and I'm going to talk about real estate, which is deeply related to economics, and I think that's my comparative advantage in this particular panel. We talk about real estate. There's some key things to take out of the economic news, and I'm happy to hear how good it sounds like it is locally. First of all, Portland's economy is expanding, the unemployment rate is dropping. All these things are positive for the real estate markets in general. You take a look at what employment growth does is, first of all, it drives directly the need for office or industrial space. It also supports continued household growth to the extent that our unemployment rate was 9%. It's difficult to induce net new in-migration, even if it is talented and a creative class, and creates commensurately a demand for residential units and increases buying power, increases demand for retail. So basically the major real estate product types have got fairly good fundamentals underneath them all. One of the things we've seen nationally in the real estate market that's really driven it a lot in the last probably 5 years is an increasing turn since the equity market crash in the late 1990s of seeing real estate as an important investment tool. Because of that, we see a lot of money chasing actually less deals. And also as a result of that, what we have is we have pricing that doesn't make a lot of sense. We've got pricing that's very high, it's helped the markets, it isn't always rational. Well, one of the things we have to remember though is the markets are cyclical, and each separate market type or product type has different cycles in this market. And right now we're fairly well established and maybe mature and fading and overripe in some of our market segments, and other segments are coming forward. And we'll try to walk through these sort of one segment at a time and deal with some of these issues. First of all, I think Joe talked about an index of how many people show up for the meetings. To give you the same index I was talking to John about before this meeting, I do a home builder forecast every year in December. Traditionally, it's about 350 people come to this, and they had 650 in the last meeting. The home builders are sitting on a lot of inventory right now, and there's a lot of uncertainty in that home building industry. We talked to them the year before, and we talked to the audience and asked how many have been through the last downturn in real estate for residential real estate, and that was honestly almost 20 years ago at that point in time. And very few people in that crowd had actually seen a downturn. They're going to be seeing one this next year, and hopefully not that pronounced, but certainly a change in market dynamics. One of the several reasons that have been driving this for the ownership residential market, first of all, is demographics. We talk about the aging, and people are getting into prime earning years, higher household home ownership rates. We've had very low interest rates. We've seen the home ownership rate in the Portland metropolitan area go from about 55% in '95 to 67, 68% in 2006. That translates to almost 40,000 households leaving rental apartments, moving to ownership housing, even without growth. We take that sort of shift in home ownership rate, there's no question that the ownership rental market has had very favorable demand characteristics, particularly in line with ongoing economic growth, which we're seeing now. The flip side of that, of course, has been the rental apartment market, which has been down for almost a decade now, with rents that really haven't hit their pro forma numbers from 10 years ago, and they're just starting to hit those right now. We take a look at the different cycles, and we see in condominiums a sort of long in the tooth cycle on condos. We've had a great run in condos. We continue to have a good run in condos. There's going to be some weakness on the margin. If you bought a condo to flip in the last 6 months, that might not have been a good move. If you bought it 2 years ago, you're still golden. I mean, things have worked out. People keep talking about, look, we're down 3%, we're down 5%. We were up 20% last year. I got called by the Oregonian, who was concerned in January because year-to-year housing appreciation was only up 17%, and was up 22% the month before. And it's, neither rate is sustainable in any standpoint. So the fact that we're giving up some of our gains is probably normal. We're dropping to a more normalized curve. Nonetheless, there is an aspect to pricing, little mania in the market where people saw huge investment gains because of the 20% gains. We had a lot of speculative activity in there. We'll see slowly pulling out of the market and softening the ownership market. Flip side is rental apartments are finally looking really good. One of the things, the real challenge here for our young creative class is their rents in the close and east side are going to go up about 20% in the next year and a half. And we're going to see one of the things that Portland has offered is on the West Coast is a relatively affordable market. For all the appreciation we've seen locally, we're still the low-cost location on the West Coast, but for renters, some of that advantage is going to be going away. And a lot of it's because they finally have some pricing power because occupancy rates are high enough to move pricing and we're not losing as many people to ownership housing. So with that, people will be trying to move the price to the point that they justify replacement cost. The typical real estate cycle is that the market overbuilds the market. Developers do what developers do, which is overbuild the market, the rents get soft, the market fundamentals don't allow you to underwrite new product, nothing gets built until the market tightens up and rents move again. We're at the point now where the market's tightened up and rents are moving, and we still have a ways to go till we can justify new construction. But we will see new construction, we expect, the next year or two. It's just that it'll be at sharply higher marginal rates. We talked about investors. If you're an investor out there, again, the ownership market, long-term play is okay. If you've got rental property, that's probably good. Because rental, you should get better income. At the same time, your cap rates or how people value the market in the secondary markets are likely to be rising as well. So as an investment, you may be getting some and losing some at the same time. The primary thing we see for small investors is that there's too much money chasing too few deals, and the yields are really poor right now. We've been saved by poor yields on income by the fact that underlying asset appreciation has been increasing at a very rapid rate, which has saved everybody. You're getting 3% return on your money and negative leverage on your actual home on renting it, but you're making 10 to 15% a year on appreciation. We expect that 10 to 15% a year to drop down closer to 5%, and the rents, even with a 20% rise, it only gets you 3.5% return on your money. So the investment proposal is not as good as it used to be, but it may still be one of the better games in town. Take a look at the office market, and we have trends improving. We have one of the strongest office markets in the country for suburban office. The real weakness in Portland's office market, which is continuing, has been the downtown Class C rehab market, which is very soft. I am currently office in downtown Class C rehab space because it's the best bargain in the city, in the whole metro area right now. Very low-cost space. It's not a good news if you're a landlord, but if you're trying to rent space, it's positive. We've had trouble really moving the downtown space. The cruise way market is phenomenally strong. We're seeing the rebound in the tech sector bring some of the market back on the west side as well. The industrial market's improving for some of the same reasons, but one of the things they're facing, which is also being faced by the condo markets, is increased construction costs. We've seen sharp rises in steel and concrete costs in the last year, which has moved construction costs remarkably high in a short period of time, a fairly large move. And because of that, we need higher rent levels, and by and large, rents haven't moved in the industrial market for almost a decade. They're going to have to move or we won't see new product come because you can't make it underwrite. The retail market is really tenant-driven. As long as we get continued population and employment growth, we should have buying power remaining strong. There is an issue of the home equity issue, which has sort of been people's, bank account of last resort or first resort right now, where people are withdrawing a lot and driving a lot of economic activity. To the extent that they don't feel those gains are there, they feel sort of a paper loss that may affect some of their consumption activity on the edge. But the real issue with retail, and retail is a very Darwinistic sector, is it's really driven by tenants. If your tenant type is appropriate and it matches the current tenant types, you should be okay in retail space. Retail space redevelops constantly because there's always a new, better game in town and someone comes up with a new concept. So you constantly see this redevelopment thing. I think right now, if you're in the Portland metro area, all the moves now in the margin has been to redevelopment of space. The economics of redevelopment are difficult to deal with, and I think a lot of jurisdictions are finally getting their hands around it. One of the big problems you have with redevelopment is it typically requires relatively high rates. On the other side, even if it's not the highest and best use, if you've got some residual value, it's very difficult to get redevelopment to occur. And more people are seeing that as sort of the only option for development community to get development in areas is infill development. So we are seeing a lot of move to infill development. We are seeing the investor and developer capital talent go higher, which I think one of the things Joe talks about is talent. I think in the development community, the Portland development community has gotten much more talented in the last few years, and I think is much more effective than they used to be at doing some of these deals. So we expect to see those responses, and we have seen those, so we feel pretty good about it. In general, on the real estate market, people always, I think, focus on ownership residential because that tends to be people's largest investment that they hold. And we do see that sort of moderating. We don't see a disaster scenario. Despite the fact we've had a pretty good run-up, we haven't had as large a run-up as they've seen in California and other markets. We do see a little bit of a pullback. We see some less promise if you're a speculator, but we think things are going to be pretty solid. The income property markets all look really good right now. So even though we're going to see a drop in residential construction, I think we're going to see commercial construction kicking in again for the first time in the next couple of years. And that's it for the real estate.
Thank you. We'll move to the question and answer part of our program. Those of you who are members who would like to ask questions, you can line up over at the microphone. So as to allow a number of people to have an opportunity, we'd ask that you limit your question to 30 seconds, that it end with a question mark, and that it not resemble a speech. Our first question will be asked by our board host, Tamsin Wazell. Tamsin is secretary to the City Club Board of Governors. She's past chair of the City Club's Research Committee Board, and she's a partner in RTS, which is an organizational development firm. Tamsin.
I'll give some of you a thrill. If you know, in the past when I ask questions, I always sit down because there's really not much difference in my height when I stand up. But I thought, well, I'll do something different today. There's been a number of things in the news lately, gentlemen, and the one today in the paper was again about the purchase of Oregon Steel. Of course, today's paper was about the executive compensation of it, but much of the buzz about the purchase of Oregon Steel could be characterized as the Russians are coming, the Russians are coming. But from an economic point of view, is this a sign of things to come that we're going to start to see more foreign ownership in assets that are in Oregon? And what are the implications for the average Oregonian for having these kinds of buyouts happen?
Well, I mean, I would argue that this kind of stuff's been going on all the time. The United States has been doing it for years and years and years. Now we have a capital inflow into the United States. You've seen a lot of consolidation in this, in the steel industry. But I mean, is it something new here? Look, I mean, Freightliner. Who owns Freightliner? Who owns Burger King? We've got lots of foreign investment. We could talk about Hynix and other, Wacker Siltronic. I mean, it's going to be one of the sources. I would argue it's probably going to be one of the sources of growth in Oregon. That capital inflow from overseas. It's helped hold down interest rates in the United States. And I mean, it probably, I think, from a standpoint of Oregon Steel, and I don't have any, insider information, probably helped stabilize Oregon Steel. I mean, you have to remember a few years ago, Oregon Steel was having a pretty tough time. I mean, City of Portland wouldn't even give them a contract that they were the low bidder on. But that's another story.
Yeah, just, what we're seeing, I think, is really a reflection of the trade deficit writ large. I mean, we're giving foreigners valuable coupons, hundreds of billions of them, that they can redeem for real assets. The Japanese, the Chinese, and the Russians all have, measured in hundreds of billions of dollars that they can, spend on things in the United States, and companies will figure prominently. But I think the real issue is, for the health of those companies is, do we have the resources, the assets here locally, particularly the talent, to be successful in those companies? And who owns them is probably actually a secondary consideration.
Jonathan Hart, City Club member. I guess it's for everybody. We are, as you mentioned, a lot of us getting to that point where we're going to be retiring and pulling our money out of 401ks and IRAs and so on, instead of investing back into them. Is that going to have a significant effect on the economy here in the next couple of years? And is that going to drive a little more investment towards real estate?
Well,
real estate twist.
go ahead, Jerry.
No, no. You threw the real estate twist in at the end because I was thinking this was John's question. You know, to the extent that people are using real estate assets as retirement mechanisms, I think that's definitely been the case. People have picked up a lot of this. One of the things that's be interesting to watch as people retire from the real estate market perspective is we see a lot of move down pressure. We see the people who are buying at South Waterfront in the Pearl District, an awful lot of it is move down. It isn't, you know, young creative class. They can't pay $600 a foot. It's a move down market, and one of the things we've been seeing is how they dispose of their home on the backside. Until they die, their kids don't have enough money to buy them out. And is there enough of a surge behind the baby boom to really pick up some of the assets they're unloading on the backside? As somebody with 3 kids, I feel pretty good about the prospects for getting good deals on relatively large homes from move down baby boomers in the next 5 years. That's sort of the real estate impact side.
You know, one of the things about that whole process is, remember, you know, the first boomer will, of course, be 62 on January 1st next year. But any drawdown is going to take place over an extended time, an extended time period. It's not a sudden thing. And you've got 2 generations behind. You've got a generation that's almost as large, that's getting all kinds of incentives to save and accumulate for their own retirement. And Joe talked about, we've got this massive capital inflow from overseas. So I don't have great worries about financial asset prices over that process. I mean, there's a bequest motivation, that sort of thing. So I don't think it's going to be a sudden liquidation.
And the other thing we know is that when people retire, their likelihood of moving across state lines, moving across among communities, increases pretty dramatically. And so I suspect as baby boomers retire, we'll see a resettlement pattern, a sorting. Some places will empty out, and other places will do even better. And I think if you're looking for a good rural development strategy in the United States, being attractive to boomer retirees is probably one of your very best opportunities.
Ron Cease, a member of the City Club and a retired professor from Portland State. Joe, I was very much interested in your comments on the increased number of people with degrees. Can you give us any sense of what the mix might be in terms of people coming in with degrees versus people that are local and earn degrees in the state, maybe even earn them elsewhere, but they're residents of Oregon before they start? And then particularly, what is there about Multnomah County that accounts for your comment that its rate now is about even with Washington State? What's happening? What's different going on here now than over the past?
Okay. Best we can tell, it's about 50-50. Half of the people with college degrees in this age group have moved here in the last 5 years. Why they move? 2 interesting facts. One, we looked at where young people are moving in the United States, and as a group, people who are 25 to 34-year-olds today are about 30% more likely than other Americans to choose to live in what we call close-in neighborhoods within 3 miles of a central business district. That compares to a rate of about 10% more likely 10 years ago. So there's been a big generational change in locational preference. And we've done focus groups and other studies. In Portland, the answers read like what I would call the new urbanist bullet points, that people are looking for places that have housing density and diversity, a diverse population, interesting commercial districts, good transit, walkable, bikeable, parks, schools. So the kinds of things that we've been focused on for a long time in Portland turn out to be very powerful inducements to a big segment of this group.
Sharon Van Sickle-Robbins, City Club member. Joe, I think this is for you. There's been a lot of talk about whether the growth in the metro area has been happening equally across all parts of the region, and particularly whether the city of Portland has experienced growth or job loss into other parts of the region. Can you comment on that and talk about the stats?
Yeah, and one of the things that I do regularly is look at the universe of all the large metropolitan areas in the United States, every metro area with 1 million or more population. And we've done a lot of work to look at the structure of the job bases, whether they're centralized or dispersed. Portland has one of the most centralized patterns of employment of any large metropolitan area in the United States. And so we've had actually less suburbanization of employment. Part of that is due to the urban growth boundary, but part of it is we just have more jobs within 3 miles, more jobs within 10 miles of the central business district than other metropolitan areas.
Steve Novick, City Club member. Yesterday, Gordon Smith, who favors every form of spending and opposes every form of taxation, gave up his chairmanship of the Senate Subcommittee on Long-Term Debt Reduction. But even with his departure, I don't see Congress taking dramatic action to address the long-term fiscal crisis that David Walker, the Comptroller General, described here a few months ago. At what point do you think long-term interest rates will start reflecting what I see as the likelihood that by around 2020 we'll start printing money like Weimar Germany to cover our debts and we'll have skyrocketing inflation?
I was having trouble understanding the question. When will interest rates go up because of the deficit? Well, one of the interesting things is, of course, we've been drawn on partly relates to what we talked about earlier. We've been drawn on a global pool of savings, and you've had interest rates, basically interest rates go down. We used to worry about sort of the traditional concern about deficit was, okay, crowding out. Okay. You haven't seen that happen because that capital inflow has, in part, because that capital inflows come in from overseas. When that's going to happen, or if that's going to happen, I mean, I don't know. I think there's certainly a long-term threat, particularly with the growth on the entitlement side, that's going to have to be addressed. I think we're getting at least sort of more experimenting going on at the state level. We got efforts underway in Oregon. You got Massachusetts. Governor Schwarzenegger's coming out with a plan next month. So I think we're sort of stumbling toward addressing those long-term entitlement issues. One of the exciting things about the election is the last election is we may now see sort of more move on those areas, particularly in the face of the aging population.
I think it's a big uncertainty. You should remember that getting advice from economists is like getting driving directions from somebody who's looking in the rearview mirror. It's fine as long as the road is straight, but when you hit a curve, you don't necessarily get good advice. And there are a couple of big risks. We have, obviously, our fiscal situation. Given where we are in the economic cycle, we're spending in a very stimulative way when we should probably be addressing some of the issues, as the Comptroller General suggested. And we also have a huge and unsustainable trade deficit. And the day of reckoning could come in terms of the value of the dollar and, as you suggest, Steve, in terms of what happens with interest rates and inflation. And I think just as economists, we're not really well equipped to predict how we deal with big events like that.
Joe, I listened to a speech by a nationally famous economist here last month, and he had an interesting point about trade deficits, capital flows. He said, remember, the United States had a trade deficit every year from 1640 to 1870. And we got good numbers on that because they kept track of it because that's how they raised tax revenue. Yeah.
And great point, perfect point. And at that time, we plowed all of that foreign investment into real physical capital investment. Right. And essentially what we've done with our trade deficit now is an immense spending spree that's shown up in part in regular consumer goods that we're importing, but also show up in the housing sector. Yeah. And that's a very, very different form of investment. So don't kid yourself that because we got a big inflow when we were building this country, that's the same as what we're doing now. Because it's not.
The point I was trying to make is we've had episodes where it's gone on for a very long time, and it depends on decisions made here as well as decisions made elsewhere in the world.
And as long as we make the investments that do things that make our economy more productive in the long term so that we can pay those things back, great. But it's like maxing out your credit cards on video games for your kids. It doesn't add to your productive capacity.
You do have to keep in mind also that I think by the EU standards, we're the only ones outside of us in Ireland and I think Yugoslavia that would actually qualify for the euro. Its percentage of deficit is a percent of GDP.
David Margulis, Downtown Merchant. A question to Jerry Johnson, who touched on two areas that are upsetting to me. One, cruiseway gaining so many people, and how could we attract those jobs back to downtown Portland? One. Number two, you touched on your presence in a Class C building. Does it make sense to convert some of the Class B or Class C buildings into living? How can we get more market rate housing in the core center of downtown to provide more income downtown and not just growing the housing for affordable housing?
One of the issues, to address them first one at a time, we talk about the cruise way situation. That really reflects the fact that businesses don't need to be anywhere anymore. They're much more footloose than they used to be. Now, law firms like to be in by courthouses and things, but more and more where executive housing concentrations have been key attributes that people have built towards. And what you see in Cruise Way is basically, Lake Oswego building offices. They don't have to go on any commute pattern to go into. And to some extent, you're getting better jobs, housing balance. Maybe that's positive in some extent as well. It's also easier to serve the high-tech corridor in Washington County from Cruise Way than it is from downtown. We are sort of developing this situation where downtown is where you live and go to do, and you work out in the burbs, sort of a reverse situation from historical norms. And I do take a look at what you can do with the Class C rehab space. The problem, we've looked at some of these redevelopment activities to try to convert that to housing, and the code issues and seismic reinforcement. I'm in a seismically unreinforced masonry building, which I'm high enough up, maybe I walk out at ground floor and the rest of the building collapses. It's hard to know. But we looked at these before and what it takes to improve them. It is phenomenally expensive, and they find the market won't pay the difference in what it costs in rents to improve it. If you take it and change use, your building code is going to require a full seismic upgrade. Your retrofit is going to be remarkably expensive, and you may find it's cheaper to knock it down and build from scratch. Even though the space looks cool and it's very nice space, it's surprising how much that stuff can cost to retrofit.
Bill Holmer, City Club member. The Tax Foundation recently released a report describing the various tax systems in the various states and how business-friendly they were. Oregon ranked 10th most business-friendly, and Washington ranked 11th most business-friendly. And since our economic region includes not only Multnomah, Clackamas, and Washington County, but also Clark and Skamania County, does this sort of divergent tax structure, because you couldn't have two tax systems which were more divergent than what Oregon and Washington have, is that good for our regional economy or not?
Yeah, there's a tremendous mythology that surrounds the importance of taxes to regional growth. My view, reading the literature, is that it doesn't make a very big difference. But if you believe it does make any kind of a difference, you're right. It's a huge asset, because no matter what kind of business you are, you can find a very favorable tax environment on one side of the river or the other. And the fact that disproportionately the economy is located, the employment is located on the Oregon side of the river, tells you that Oregon's is probably considerably more favorable to business overall than Washington's.
Yeah, I agree. There's a tendency to overemphasize the importance of that. Now, that said, are there border effects? Yes. Okay. In some of the locational patterns that people make. I think the real issue on the Oregon system is the instability question. We rely more than any other state on a volatile income tax with no significant reserve fund. I think that's a huge issue. It's a much more important issue than it was prior to the passage of Measure 5, when you shifted functions to the state revenue source. And I think that is a real problem for the state.
On behalf of the City Club of Portland, I'd like to thank our members and guests for your participation here today. I'd like to thank our television and radio audience for your interest in City Club. And finally, I'd like to thank and ask you to help me thank John Mitchell, Joe Cortright, and Jerry Johnson for a great presentation. We are adjourned.